Hello, this is going to be a video of the Chapter 1 homework. Alright, so we've got chapters 1 through 4 are already uploaded into Blackboard by chapter. They're located over here, or if you go into each one's chapter, well, let me pause and stop. Okay, I'm back. This should work. Alright, so you can link into the chapter, each chapter here, or when you go to the content by chapter, it's also in each chapter folder, okay? So here are chapter 1's scan pages, and I had to break them into sections. For some reason, it wouldn't scan them all at one time. The homework questions are in the last section, okay? So basically, you're good for through chapter 4, which is our first, full week. But then you need to have a book. And there are none in the bookstore. You have to buy them online or rent it online or get an e-version, whichever you would like to do. All right, all the homework comes from the exercises, which are at the back. They start with these short exercises. Notice there's an S in front of them. And then as you scroll through, you'll find one that's where it starts with exercises and they have an E in front of them. But what I want you to note is that the numbers are still continuous. They don't start renumbering. So it doesn't really matter if I put an S or an E in front of it. There are also problems later on with the P in front of them. But they're still in numerical order. So it doesn't really matter what the letter in front of it is. All right, but this is where your homework comes from. Okay, so you're going to work all your homework in Excel. Our first one, I already have Excel up here. We need to do number 1, 5, 6, 10, 11, and 16. All right, so number 1, normally what you would want to do is either read the chapter or watch the lectures that go with chapter 1 and then come and do the homework. Okay? And typically what I do for the videos is I split the screen and then I have the homework question on one side and I do the answers in Excel on the other side. All right, so this is 1-1. All right, for each of the user of accounting information, identify if the user would use financial accounting or managerial accounting. All right, so the first one is an investor. They would probably use financial accounting. All right, financial accounting is typically used by people outside of the business. Managerial is more for people that are inside the business. All right, a banker would probably also use financial accounting. You don't need to capitalize that. I don't know why I'm doing that. You also do not need to retype the question itself. You can just put the answers. All right, the IRS. I'm going to say financial again there. Although they probably use a little bit of both, but it's all right. All right, the manager of the business would want managerial. The controller would probably use both. The controller is like the head of the company. And I can see them being interested in both financial and managerial. Managerial accounting is more things like how much does it cost to manufacture this product? How much can we sell it for? How much do we need to sell it for to make a profit? It's stuff like that. So F, the stockholder, is typically financial. The human resources director, probably managerial. They're inside the company. And a creditor is somebody who lends money, and they would probably want to know the financial accounting, financial info. All right, so number 5. All right, there are some assumptions and accounting principles and assumptions that are in chapter 1. So you need to, read through them and then apply them when you're doing number 5. All right, Michael McNamee is the proprietor of a property management company, Apartment Exchange, near the campus of Pensacola State College. The business has cash at $8,000 and furniture that costs $9,000 and has a market value of $13,000. The business debts include accounts payable of $6,000. Michael's personal home is valued at $400,000 and his personal bank account has a balance of $1,200. Consider the accounting principles and assumptions discussed in the chapter and identify the principle or assumptions that best matches the situation. All right, Michael's personal assets are not recorded on the apartment exchange's balance sheet. All right, this has to do with separate entities, separate economic entities. All right, y'all, I can't type. Sometimes I can't talk. You'll find that out as you watch these videos. All right, you want to keep everything separate. You want your business separate from your personal life. And if you have more than one business, you want to account for each business individually as well. So there's separate economic entities. All right, the apartment exchange records furniture at its cost of $9,000, not its market value of $13,000. All right, we apply something called generally accepted accounting principles. And among those principles is something called historical cost. And in the United States, we record assets, which is furniture is an example of an asset, at their historical cost. And because our inflation is relatively low compared to other companies, we assume that the dollar remains constant. So we keep it at its historical cost on our books. We do not adjust to market value. All right, the apartment exchange reports its financial statements in U.S. dollars. It's the dollar assumption, but let's see if I can see what they call it. I'm going to pause and go find it. Okay, so I'm in the second link to the chapter 1 on page 10. I think I'm in the second link. I don't know. I couldn't swear to it. Actually, no, I'm in the first link, page 1 through 12. And then here's all these assumptions that I'm pulling from. Okay, they actually start on page 6. And then the one we were specifically looking for was the dollar. All right, and that's this monetary unit assumption. Okay, so let's go back to the homework question. I think it was number 5, yes? Yes, so the apartment exchange reports its financial statements in U.S. dollars, and that's the monetary assumption. And then D, Michael expects the apartment exchange to remain in operation for the foreseeable future. That one's called the going concern. Some of these assumptions change if you think your business is going to be going out of business in the near future. All right, number 6, the accounting equation. Okay, so the accounting equation is pretty important. You really need to understand the accounting equation because everything keys around it. All right, Thompson Handyman Services has total assets for the year of $18,400 and total liabilities of $9,050. Use the accounting equation to solve for equity. Okay, the accounting equation is assets equal liabilities plus equity. All right, so number 1 here, part 1, whatever they want to call it, we have assets of $18,400, and those equal our liabilities of $9,050 plus our equity of, we don't know what. We have to solve for it. Okay, so all you need to do is subtract. Try to use formulas as often as possible. Get really used to using the formulas in Excel. So here's our answer. Equity equals the $9,350. And I like to make things have dollar signs and all that type of stuff. Okay, if the next year assets increased by $4,300 and equity decreased by $3,850, what would be the amount of total liabilities for service? So there's actually a couple ways you could do this one. All right, I'm still using the same little formula up here. But basically now our assets increased by $4,300. So our assets were $18,004 plus $4,300 because they went up. All right, we don't know liabilities. This is the one we're solving for now. But equity decreased by $3,850. So equity started out at this $93.50 and went down by $3,850. So we don't know what liabilities are. So once again, we're basically gonna subtract the assets minus the equity. And that equals my liabilities. And that's about the hardest math we'll do in this class. All right, it's pretty straightforward as far as math goes. It's just adding, subtracting, multiplying, dividing, and that's about it. All right, number 10. All right, so this one we're also going to use the accounting equation. And we're basically going to talk about with each transaction, what's going up or down because of the transaction. All right, so Elaine's Inflatables earns service revenue by providing party planning services and inflatable playscapes. Elaine's Inflatables is organized as a corporation. During the past month, Elaine's Inflatables had the following transactions. And we indicate the effects of the business transactions on the accounting equation for Elaine's Inflatables. Transaction A is answered as a guide. So this is what we're going to do right here. All right, so it's really kind of more of a what type of accounts are affected. All right, so I received contributions of $10,000 in exchange for common stock. So we're looking at it from the standpoint of the business. All right, so the business received $10,000, so they got an increase in assets, and the asset was cash. All right. Then something else has to change on this side, and it was a contribution in exchange for common stock. So equity is going up. And it's common stock, because common stock is the element of equity. All right, B, purchased equipment for $5,000 on account. Equipment is an asset, so I'm going to have an increase in assets. And it's equipment that's going up. All right. On account means they haven't paid for it yet. They still owe for it. So that is an increase in a liability. And it's an increase in account payable is the actual account, the actual liability account. All right, C. Paid $400 for office supplies. All right, office supplies are also an asset, so I'm going to have an increase in assets, and the asset account will be office supplies. And I actually paid for them, so I'm going to have a corresponding decrease in assets, and its cash is going to go down. All right, D, earned and received $2,500 cash for service revenue. All right, so I received cash, so that's an increase in assets, and it's cash. All right, revenue is basically an element of equity, and it increases equity. All right, E, paid $400 for wages to employees. So I'm paying it, so my cash is going down. So it's a decrease in assets. and it decreases equity. So it's a decrease in equity. Equity is increased with revenue, decreased with expenses. All right, F. Cash dividends of $1,000 were paid to stockholders. All right, so they paid it out in cash. So our cash is going down. Cash is an asset. So we're going to have a decrease in assets with cash. All right, dividends also decrease equity. So it's going to be a decrease in equity. That would be my little four-legged child running around that you hear. Just having a little zoomy moment. All right, G, earned $1,000 for service provided. Customer has not yet paid. All right, that's going to be an increase in assets. And the asset that's increasing is account receivable. All right, you've earned some money. They haven't paid you yet. You have the right to receive payment. So that's an accounts receivable. All right, you earned some revenue, and that is an increase in equity. Service revenue. And then we paid $1,000 for rent. All right, so we paid it, so that's a decrease in assets because our cash is going down. And then that's an expense, rent expense, so it's a decrease in equity for rent expense. And then I received a bill for $250 for the monthly utilities. The bill has not yet been paid. All right, so that one, nothing's happening to assets yet because I haven't paid anything, but I still owe some money. So that's an increase in liabilities. And it's an account payable. Because I owe somebody, I have the right to pay them, or they have the right to receive payment from me. It's an account payable. And it's utility expense, so that's going to also decrease equity. All right, so that's what we had to do for number 10. All right, then number 11. Identifying accounts on the financial statement. So identify the financial statement that each account would appear on. It's either income statement, statement of retained earnings, balance sheet, or statement of cash flows. All right, account payable. I'm going to go ahead and write it out because I'm just going to kind of take a note. Account payable is a liability. So that goes on the balance sheet. Cash is an asset. That also goes on the balance sheet. The balance sheet is assets, liabilities, and equity. C, common stock is an element of equity. So that goes on the balance sheet. D, accounts receivable is an asset. So since it's an asset, it goes on the balance sheet. E, rent expense is an expense. It goes on the income statement. The income statement is revenue minus expenses equals net income. Service revenue. Revenue minus expenses goes on the income statement, so service revenue goes on the income statement. Office supplies are an asset. which means it goes on the balance sheet. Dividends come out of equity, and they end up going on the statement of retained earnings. That's where you actually see the dividend. Land is an asset, which means it goes on the balance sheet. And then salary expense is an expense, which means you would find it on the income statement. So that's number 11, and we just need number 16. Excuse the dog. All right. Number 16 is return on asset. These little things are usually the very last section of the chapter. So return on assets equals net income divided by average total assets. So it's going to be Mature Water Services had net income for the month of October of $50,880, and then divided by average assets. So 362 was 486 divided by 2. Oops. I don't want a correction. Oh, it's because I didn't mean to put the equal sign here. I'm going to move this piece. Yeah. $362, 6. All right, and returns are usually a percentage, so you need to change that 0.12 to 12%. And that's it for Chapter 1's homework. You can save this and submit it.